Imagine two companies. On paper, they are identical. Both possess outstanding products that dominate their niche. Both operate in high-growth industries with massive tailwinds. Both generate strong, consistent profits that attract the attention of Wall Street. Yet if you look 10 years into the future, the outcome is shocking. One has become a global industry leader, a compounding machine that has enriched its shareholders beyond measure. The other has completely disappeared from the map. What happened? In the world of serious investing, the difference is almost always one silent variable: leadership. Professional investors understand a fundamental truth that beginners often overlook. You are not just buying a ticker symbol or a balance sheet. You are entering into a fiduciary partnership. You are trusting a small group of people to allocate billions of dollars of capital on your behalf. A great management team can take a mediocre business and transform it into a fortress. Conversely, a poor management team can take an exceptional business and run it into the ground with stunning speed. Today, we dive deep into how the world's most successful investors judge leadership before ever committing a single dollar. Every critical decision that determines a company's terminal value begins with management. They are the ones who decide who to hire, which products to launch, and which markets to abandon. They decide when to take on debt and when to return cash to you, the shareholder. These decisions are the strategic engine of the firm. While beginners obsess over stock price movements, professionals obsess over the quality of the people making these choices. Leadership creates direction, and direction is the only thing that creates long-term sustainable results. It is important to recognize what management cannot control. They cannot control the global economy, they cannot control interest rates, and they cannot control geopolitical shifts. However, they have absolute control over the company's internal culture, its long-term strategy, and its daily execution. Professional investors look for leaders who focus exclusively on these controllable variables rather than making excuses for external macro conditions. This discipline is the hallmark of a high-performance management team. The first question every professional investor asks is deceptively simple: can this management team be trusted? Trust is notoriously difficult to quantify on a spreadsheet. But for a serious investor, it is the most valuable asset a company can have. We look for clues in their communication. Do they speak with candor? Do they admit their mistakes openly, or do they bury them in the footnotes of the annual report? Do they exaggerate their successes, or do they maintain a level of humble realism? In investing, trust is built through years of consistency, but it can be destroyed in a single dishonest quarter. To evaluate trust, professionals perform what we call a retrospective analysis. We read shareholder letters from 3, 5, and even 10 years ago. We look at the promises made then and compare them rigorously to the actual results achieved today. Did they expand into that new market as promised? Did they hit the margin targets they set? Management teams that consistently hit their own benchmarks are far more likely to protect your capital than those who constantly move the goalposts. Actions will always matter more than sleek investor presentations. This brings us to what many consider the CEO's most important job: capital allocation. Think of the CEO as the chief allocator. Every year, a successful business generates a certain amount of free cash flow. The question of what to do with that cash is the single biggest determinant of your long-term returns. Should they reinvest it in the business to drive organic growth? Should they pay down debt to fortify the balance sheet? Should they acquire a competitor, or should they return the cash to you via dividends or share repurchases? Great CEOs are masters at weighing the opportunity cost of every dollar. Poor management teams often fall into the trap of diversification, spending cash on low-return projects just to grow the size of the empire. They might overpay for acquisitions to boost their own ego, or they might buy back shares at all-time highs when the stock is overvalued. A professional investor looks for a disciplined framework. We want to see a CEO who treats the company's money as if it were their own, refusing to waste resources on projects that do not meet a strict hurdle rate. Capital allocation is the clearest window into the quality of a leader's mind. Charlie Munger famously said, "Show me the incentive and I will show you the outcome." This is why professional investors obsess over insider ownership. Does the management team own a meaningful stake in the company? We aren't just looking for stock options. We are looking for skin in the game. When executives are large shareholders, their interests are perfectly aligned with yours. If the business thrives, they build generational wealth alongside you. If the business fails, they feel the financial pain just as acutely as you do. This alignment is a powerful insurance policy for the investor. However, ownership is just one piece of the puzzle. We also evaluate the compensation structure. Are they rewarded for short-term stock price movements or for long-term growth in per-share intrinsic value? Be wary of management teams that are compensated based on adjusted metrics that ignore real costs. You want leaders who are incentivized to think in decades, not quarters. A CEO who is focused on their legacy will always outperform a CEO who is focused on their next bonus. Alignment is the foundation of long-term partnership. In our search for great leadership, we must be equally skilled at identifying red flags. The most common warning sign is a frequent and sudden change in strategy. If a company is a tech firm one year and a services firm the next, it suggests management is chasing trends rather than building a durable business. Another red flag is a pattern of empire building, making large, flashy acquisitions that fail to generate a return on investment. These are often driven by executive ego rather than shareholder value. When you see these signs, it's time to dig deeper. We also look at executive turnover and corporate governance. If the CFO and the auditors are leaving frequently, it is a massive signal of internal instability or potential accounting irregularities. Pay close attention to related party transactions, where the company does business with entities owned by the CEO's family. While one red flag may not be enough to disqualify an investment, a cluster of them indicates a culture of self-interest rather than fiduciary duty. The goal of this analysis is not to find perfection, but to accurately price the risk of the people in charge. Corporate culture is often dismissed as soft by amateur investors, but professionals recognize it as an invisible moat. A healthy culture is characterized by high employee retention, a shared sense of mission, and a disciplined approach to decision-making. Culture is what dictates how employees act when the CEO isn't in the room. In a high-performance culture, innovation happens naturally because people feel empowered to take calculated risks. Conversely, a toxic culture will eventually erode even the strongest competitive advantages through high turnover and internal friction. How do you measure something invisible? You look at the results. A company with a strong culture consistently delivers high-quality products and superior customer service, even during difficult economic cycles. They are able to attract top talent without paying significantly above market rates. This cultural resilience is a massive competitive advantage because it is nearly impossible for a rival to copy. As an investor, you want to back teams that have built an environment where excellence is the default, not the exception. Execution is the tangible proof of a strong culture. Every management team will eventually face a crisis. The true test of leadership is not the absence of mistakes, but the response to them. Did they own the failure immediately, or did they try to shift the blame to market conditions or unforeseen events? Professional investors look for anti-fragile leaders, those who use setbacks to improve their processes and emerge stronger. A CEO who can navigate a company through a recession or a product recall with transparency and decisiveness is worth a significant premium. Adversity is the ultimate filter for management quality. There is a fine line between confidence and arrogance. The best leaders possess an intellectual humility, the ability to admit they don't have all the answers, and the willingness to pivot when the facts change. In a rapidly evolving world, adaptability is more important than a rigid 5-year plan. We look for management teams that are constantly learning and evolving. Honest leadership creates a culture of truth, which leads to better decision-making over the long run. Remember, in the boardroom, humility is not a sign of weakness, it is a sign of wisdom. When you sit down to analyze a new company, use this framework. First, read the last 3 years of shareholder letters. Do they explain their strategy clearly, or do they use vague corporate jargon? Second, check the proxy statement for executive ownership and compensation. Are they incentivized for the long term? Third, look at the historical return on invested capital. Is management actually creating value with the cash they generate? And finally, listen to the earnings calls. How do they handle tough questions from analysts? These steps transform you from a speculator into a true business analyst. The ultimate question you must answer is the 10-year test. If you were going to be away for a decade and could not sell your shares, would you feel comfortable leaving your life savings in the hands of this specific management team? If the answer is anything less than a resounding yes, then the investment is likely not worth the risk, regardless of how cheap the stock price appears. Serious investing is about the long-term compounding of capital, and that process requires a partner you can trust implicitly. Never settle for mediocre leadership. Beginner investors are obsessed with price charts and headlines. Professionals are obsessed with people and processes. A company's financial statements are essentially a record of the past. They tell you where the company has been. Management's decisions, however, are what determine where the company is going. By learning to evaluate leadership, you are looking at the forward-looking indicators of value. You are identifying the engine that will drive the numbers in the years to come. This shift in mindset is what separates the average investor from the professional. As we conclude this lesson, remember this. Every time you buy a share of stock, you are not just buying a piece of paper. You are becoming a partial owner of a living, breathing business. And as an owner, you are placing your financial future in the hands of management. Choose your partners wisely. A business with great economics and poor leadership is a tragedy waiting to happen. But a business with solid economics and world-class leadership is a wealth creation machine. The people are the most important part of the equation. Your homework for this lesson is to select 3 companies in your portfolio. Go to their website, download the last 2 proxy statements, and find out exactly how much stock the CEO owns. Then find a transcript of a quarterly earnings call from 2 years ago where they missed their targets. Read it carefully. Did they take responsibility or did they make excuses? Write down your conclusion on their leadership quality before you read a single analyst report. This exercise will sharpen your instincts like nothing else. Today, you've taken a significant step toward thinking like a professional institutional investor. You've learned why management matters, how to judge their trust, and how to evaluate their capital allocation skills. In our next lesson, we will move into competitive analysis, how to identify the moats that protect a company's profits from rivals. Make sure you are subscribed to Wealth Entertainment 21 and have notifications turned on. Remember, great companies are built by great leaders, and great investors are built through continuous learning. I'll see you in Lesson 4.